Kate Warne, we've got a lot of mixed to negative signals right now in the market. We've got a Fed rate hike presumably on the way. We've got global terror in the headlines. We've gotten some less than stellar retail earnings. So what should an investor be thinking about heading into the end of the year and into 2016?
Well, we actually think the investor should be looking for opportunities in an environment like this. Despite all those headlines, underlying economic growth is positive, and we actually think earnings growth will be better next year than this. So this is the time to position your portfolio for better growth in 2016 and not to pay so much attention to all of those headlines. We also think the consumer is actually going to be okay, especially with the holiday season.
Well, the consumer should be okay because oil and gas prices are low, and one stock you like is Schlumberger. They've cut a whole lot of costs with $40 oil out there. So what's going to turn the stock higher in 2016?
Well, we actually think it's partly those cost cuts and the fact that they operate more internationally than in the U.S. and more of the production cuts have occurred in the U.S. That actually gives their business a better profile. But it's the fact that even with $40 oil, the cost cuts that they've taken give them the ability to generate earnings growth and dividend growth. And we think as a result, now's the time to be looking at it, not because necessarily oil's hit its low, but because with oil at $40 a barrel, Schlumberger, of course, reflects that. And you should start looking for opportunities in the oil patch, even if oil moves down short term.
And you're also positive on Lowe's. Their rival, Home Depot, came out with great third quarter earnings today. I think Lowe's reports tomorrow. That stock's doing very well, up almost 20% year to date. So what takes it higher?
I think it's the continuation of the strong housing market that we are seeing. Consumers really focus on nesting, which of course helps Lowe's as they do home improvements and renovations, and connections. And it's that consumer that's really spending their money in different places that I think is part of the retail headlines that you mentioned earlier, but it really helps Lowe's. Why do we think Lowe's is well positioned? Well, again, it's increased spending as consumers do better. It's the housing market and the fact that they're very well positioned in the marketplace. Less online competition, more things because you actually are buying the goods, taking them home.
And then finally, you are a fan of Novartis. Stock's down slightly this year, pays a nice 3% dividend. Talk about your expectations for Novartis in 2016.
Well, we think it's got one of the best drug pipelines in the pharmaceutical area. And it's really got three lines of business. It's not only got those pharmaceuticals, which should be able to continue to grow earnings, but also generics and the fact that it's got the eye care business. That diversity, we think, helps it a lot. We think they'll be able to grow earnings and dividends around 6%. And with that nice yield, it's a little more defensive. And we think healthcare is an area that continues to grow. Good times, bad times. So for all of the people who are so worried about your headlines, think about Novartis and maybe the prescription for your portfolio.
All right. Well, thanks a lot, Kate.
Thank you.
And thank you for watching The Street.